JP Morgan just closed their short position in silver at the exact market bottom on Friday, and they're blaming it on the Fed chair. I wasn't going to make this video. I'm literally skiing in Japan right now, but sitting on that ski lift, I realized what just happened in the silver market, and it made my blood boil. Mainstream media is feeding you the wrong story, and you deserve the truth. Here's what happened. JP Morgan sold at the exact bottom on Friday. That's fact number one. Then we had a series of convenient coincidences. The London Metal Exchange, the second most important venue for silver trading, went offline on Friday. HSBC, the second largest short holder on the LBMA, their systems also crashed at the same time. Meanwhile, the CME in Chicago raised margin requirements to shake out leveraged traders. They waited for Asian markets to close for the weekend, then rattled the market with news of a new Fed chair. A lot of coincidences. Whether you believe in coincidences or conspiracies is up to you. What I can tell you is this. We just witnessed the biggest silver crash in 44 years. A 35% drop in 24 hours. $3 trillion wiped out. This could either be the buying opportunity of a decade before silver hits $150, or it could leave you paralyzed on the sidelines. Let me break down what really happened. On Thursday, silver hit $120. On Friday, it crashed to $78. The worst day since 1980. Gold fell 12%. $3 trillion in market value, gone. But here's what mainstream media won't tell you. This wasn't a market failure. This was an engineered flush. I looked at the CME silver margin data, and I couldn't believe my eyes. I searched the web. Nobody had written about it. I searched again Friday morning. Same thing. This discovery changes everything about what just happened. My name is Felix. I'm a former investment banker who's been studying this for years. I'm the founder of Gold Academy, where we've taught over 20,000 students, and co-founder of Trade Vision, where we make Wall Street data available to regular investors. A month ago, I made a video about the December silver crash when we hit $84. I showed you the pattern. 1980, 2011, 2025. Same playbook, same players, same outcomes. They just did it again, but this time, it was 10 times worse. Let me break down 3 critical things. First, what actually triggered the massacre and who won. Second, why my thesis is actually stronger now, not weaker. And third, the moves you might want to make right now. Let's start with perspective. Silver hit $120, then crashed to $78. That's a $42 drop, 35% down. Gold dropped 12%. Mining stocks got destroyed. The gold miners ETF dropped 12%. The global X silver miners ETF fell almost 15%. If you watched my last video, this sounds familiar. It's the 4th time we've seen this pattern. In 1980, the Hunt brothers tried to corner the silver market. Silver hit $50. The exchange implemented new rules that restricted buying and only allowed selling. Silver crashed 80%. In 2011, after the financial crisis, silver hit $49. The CME raised margin requirements 5 times in 2 weeks, down 48% again. Same playbook. December 2025, we hit $84. CME raised margin requirements twice during thin holiday trading. Silver crashed 13%. Now January 2026, silver hits $120. Trump nominates Kevin Warsh as the new Fed chair, a traditional hawk who signals less money printing. Leveraged positions got margin called, stop losses triggered, algorithmic cascades, and silver crashed. 4 times now. Same pattern, same players, same outcome. So how do you know when the market bottom is in? What if silver tests 55 next week or bounces back to 100? Some people panic sell after crashes like this. That's how you lock in losses. Others ignore fundamentals and follow noise. But these are engineered events. Technical analysis goes out the window because someone is pulling the strings. If you're trying to time the exact bottom or panic sell, you're playing their game. And in their game, the house always wins. Here's what Wall Street doesn't want you to know. This crash did not solve the supply problem. It didn't create more silver. It didn't reduce industrial demand from solar panels, electric vehicles, and AI data centers. It didn't change the fact that we're in the 5th consecutive year of a 200 million ounce annual supply deficit. The smoking gun? The CME hiked margins aggressively, forcing traders out of their contracts. With a stroke of a pen, they made it impossible for traders to hold positions. Exactly what happened in 1980 and 2011. The paper silver market is being reset. The CME, where people trade contracts for silver they don't actually own, is being dismantled. Here's the critical part. They can manipulate the paper price, but they can't create physical silver out of thin air. This crash flushed out leveraged retail traders. Leveraged silver ETFs went down 66%. Stop putting leverage on something like this. It's insanity. Who was feeling pain from silver prices going up? The banks, the commercial shorts. Now, they could cover their positions and reset sentiment before the next leg up. This is a feature, not a bug. This is how the system has worked for decades. Mainstream media keeps talking about how Kevin Warsh crashed the market. That was the match that lit the fuse. Trump nominated Warsh to replace Powell as Fed chair. Warsh is perceived as a hawk focused on fighting inflation, not printing money. The market had priced in a dovish Fed. The Warsh nomination obliterated that narrative. The dollar surged. And since gold and silver are priced in dollars, when the dollar strengthens, it makes metals more expensive for foreign buyers. Demand drops, prices fall. Here's the thing. This was the most crowded trade on the planet. Gold was up 66% last year, silver up 135%. Everyone was in precious metals. Retail traders, hedge funds, institutions, everybody. When you have a crowded trade like that, a small catalyst causes what Wall Street calls a liquidation event. Leverage positions get margin called. Stop losses trigger. Algorithmic trading starts selling. And if you're running the trades as the broker or exchange, you know exactly at what price levels everything gets triggered. What's normally orderly profit-taking turns into panic. Then, just before the market closed on Friday, when Asia was already closed, Reuters pushed out a report claiming the U.S. was ending support for strategic metals. The Energy Department called it false and deliberately misleading. Think about that. The government says this is deliberately misleading. Why would someone deliberately mislead unless they had interest in the outcome? But the algorithmic trading systems had already triggered. Mass sell orders were hitting the CME. Then came the margin discovery. With all this chaos, look for the actual mechanism they use to force liquidation. That's when I found the silver margin data. Financial news sites, trading forums, analysts, nobody was talking about this. They used the Warsh news as cover, but the weapon was the margin hike. Same playbook we've seen for decades. Let me explain how this works. Silver trades in two markets, paper and physical. The paper market is where most trading happens. These are futures contracts traded on the CME. You're not buying silver, you're buying a contract for future delivery. The paper market uses leverage. Want to buy $100,000 worth of silver? You might only put up $10,000 in margin, 10-to-1 leverage. If it goes up, you make 10 times more. But here's the critical part. The exchange can change margin requirements anytime they want. They can say we don't want 10% anymore, we want 20, 30, or 40%. And they know exactly how much margin is being used. When margin requirements get raised, you have two choices: add more money to your account or sell your position. When silver hit 120, most traders were fully leveraged. They'd used up all their margin. When the exchange hiked requirements aggressively, traders couldn't add more money. They were forced to sell. This creates a cascade effect. One person's forced selling pushes the price down, triggering the next person's margin call, forcing more selling. It's a vicious cycle. They're essentially killing the paper market by making margin requirements so high that traders can't participate. They're forcing everyone out of paper contracts. Yes, they can manipulate the paper market, but they can't create physical silver. The physical market is different. Actual bars, actual coins. You buy it, you own it, you store it. The physical market moves more slowly based on supply and demand. While the paper market had its heart attack on Friday, the physical market still has a supply problem. The physical silver premium in Shanghai, how much people pay over the paper price, is at an all-time high, about $40 above the paper market. You can manipulate the paper market with margin hikes, fake news, and algorithmic selling, but you can't print physical silver. This creates trading opportunities for those who understand the game. That's why my thesis on metals is stronger after the crash. The paper market is being dismantled, and all that's left is the physical stuff. And we have a shortage of physical. Let me walk you through the historical precedents. In the 1980s, the Hunt brothers tried to corner the silver market. They bought massive amounts of physical silver and futures. Silver went up 10 times. Then the exchange said you can only sell, not buy. The Hunts couldn't meet margin calls. Silver crashed 80%. That was a speculative bubble without fundamental demand. When it crashed, it took years to recover. In 2011, after the financial crisis, people lost faith in banks. They piled into gold and silver. Silver went from $18 to $49. The CME raised margin requirements 5 times in 2 weeks. Leveraged traders got flushed out. Silver crashed almost 50%. Again, this was a fear trade. The fear subsided, and it took years to recover. In December 2025, silver hit $84. CME raised margins twice during thin holiday trading. Silver crashed. I made a video calling it potentially engineered. But here's what was different. There was fundamental demand. Solar panels, electric vehicles, AI data centers all require silver. We're in a supply deficit. Silver recovered within weeks, not years, then went on to hit $120. Right now, we just had the crash. The fundamentals are stronger than ever. The question is, will this be like the 1980s where recovery takes years, or like December where it takes weeks? I personally believe it's the latter, but I'm not giving financial advice. You will see more of these crashes until we reach a point where silver is no longer needed as much, or alternatives become viable, or silver becomes too expensive for industrial use. This remains a strong market. If you don't have the stomach for it, I understand. Gold will probably be less volatile. You saw that Friday. Silver down 30%, gold down 12%. Think about your time horizon, your goals when you need to sell, and position accordingly. Above all, the most important risk management rule is position size. If you're losing sleep over it, you're in too much. This is the reality mainstream media won't tell you. This is how the game has been played for decades, and now you know.